Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark and how the equity markets clicked the past week. Inside Track President Eric Hadik tells us how 40-year cycles affect the markets. Real estate timing newsletter publisher Robert Campbell warns cracks are showing in San Francisco's booming housing market. Who's next? We'll talk to Ross Clark right after this.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy, Vancouver. Welcome back to This Week in Money, Ross.
Nice to be with you, Jim.
The Canadian dollar has been surging while the U.S. dollar is peeling off.
Well, Jim, that would have been the best way to have stated it going into this week. Canadian was continuing to walk its way up. The U.S. dollar was seeing some pressure, but by the middle of the week, the two of them decided to move up together. You've got Canadian economic numbers progressively getting better here. We actually had 13th week in a row with the Canadian dollar up from its bottom. And the U.S. dollar, though, against the basket of currencies, when we take a look at against the euro, the pound, the Japanese yen, it made a pretty good reversal here in the middle of the week. Mario Draghi says once again that they will do whatever is necessary in Europe to continue to be stimulative, which in fact means keeping interest rates into negative territory. And with that, the U.S. dollar turned on a dime on Thursday morning. The precious metals took it on the nose. Gold gave up probably $20-25 within 20 minutes, and then continued to see weakness through on Friday. But this has been a year of outperformance by the mines, materials, and energies after being pretty much decimated most of last year and into January of this year. With that reversal that we've been seeing, with oil prices up around $44 now, and commodities, you've got copper trading up around $2.26 right now, iron ore at its best levels in the last year. So it's putting support under the Canadian dollar.
Why has copper made such a big charge? It was around 203 just a few weeks ago.
Oh, yeah. I mean, you've got stories out of China now that they're looking to increase their stockpiles, et cetera. But they have been very good over the last decade at talking up the market after they've made significant purchases, and then by the time you hear the story, the price has already had a significant move. And when we look at this copper price, clearly we've gone from the mid 190s up to 230, which this is a pretty good rally, 20% move in the price of the copper. But invariably, as I say, the story comes out after the move.
And China has thrown $1 trillion into their market to stabilize their economy. Can they afford to keep doing that?
Well, who knows? I mean, it's one of those things. If you're a central government, you have the ability to produce whatever money you need to.
Where are the hot spots on the equity markets right now?
Well, hot spots clearly have been, as I say, in the Canadian market, outperforming the U.S. dramatically. And if we look over at the U.S. side, you got a real mixed bag here. The indices were up marginally on the week, but when you look at it, some of the big names, the Googles, the Microsoft, the Netflixes, their earnings have been pretty on the poor side, and they've taken it on the nose quite a bit. You've got some of the more industrial names, the Honeywells, which have produced good earnings. And you're starting to see a little bit of people selling into the good news and taking some money off the table. We take a look at the normal seasonality. this is the time of year that you would be looking to be loading up on consumer staple stocks, anything that, and utilities, something that would be more stable as we move into this spring, summer, early fall period where the markets have over the years not had their best performance. But this year we've actually seen a pretty hard break in some of those items. The Consumer Staples Index took a pretty good hit this week. Some of the big names, the Procter & Gamble's, the Cokes, the Pepsis, and then over in the utilities, we're likewise seeing a fair amount of selling. So you don't want to see that in a strong market. You want to see those items hold in reasonably well. And this is sort of indicative of what we saw in the first quarter of 2000 and maybe in the third quarter of 2008, when what should have been the most stable items start to give up some ground here. So still leads me to think that there is a correction in the broad market, possibly sooner than we would think.
In the automotive sector, Volkswagen announcing their settlement for their emission fudging, and now Mitsubishi admits that it's been lying about its mileage figures. Is the automotive sector kind of chancy right now? Who else has been making us believe in wrong numbers?
Well, you never know until the stories come out, do you, Jim?
But I've heard that the U.S. automotive sector has been one of their bright lights and has kept the U.S. out of recession. People still love their SUVs there.
They still do, but you have to wonder, since 2009, and you've been having this resurgence in the automotive sector in the U.S., at what point have you saturated that marketplace, and those who had held off on their purchases now have them in place? And, we're seeing that most of the purchases now are not being made with cash or with long-term loans. They're being made with leases. And so, that's, to me, that says that you're stretching this market at this point.
Ross, thanks a lot for chatting with us.
Okay, Jim, and nice to be with you. We'll see you next week.
If you have any questions for Ross, you can email him at ross.clark@cibc.ca. He's an investment advisor at CIBC Wood Gundy in Vancouver. Coming up next on This Week in Money, Eric Hadik.
Always consult your investment professional before making any investment decision.
Unbelievable harmony, spectacular performance, the ultimate tribute to the Everly Brothers and Simon & Garfunkel. Bird Dog and the Vintage Electric Band coming to West Vancouver Friday, May 6th at the K-Meek Center. Buy online and save at ontourtickets.com.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Eric Hadik, CEO and president of InsideTrack.com. Welcome to This Week in Money, Eric.
Thanks for having me back, Jim.
Eric, you work on cycles and you take a look at past history and how things in the past can maybe tell us what's going to happen in the future. You said things kind of culminate around April 19th and 20th, but really the months going into that period are also pretty interesting. What have we seen?
Well, what I described there really has its foundation in viewing time from the perspective of the natural year. And I've written about this pretty extensively over the last couple decades, and in fact in early April I updated it with another big report for my subscribers called 40-Year Cycle Date of Aggression. And it's the idea that the natural year starts with the beginning of spring, the vernal equinox, right around March 20th. And for me, the opening range, and by that I mean the first month of the natural year, is when you see a lot of activity, a lot of aggressive behaviors, both human-based and even in the earth itself. And that month culminates on April 19th, April 20th, and that's what I've termed the date of aggression, and I document going back a couple hundred years in America's history just how it has impacted us, but also if you go back to ancient cultures and civilizations, that period right after the vernal equinox, and you go back to the ancient Roman Empire and all the celebrations to the god of war, Mars, which is where we named our month of March after. It all comes together and creates this very volatile, very unstable period, particularly between March 20th and April 20th, with the culmination really in that April 19th, 20th time frame. And this year was no different. March 20th, 21st, maybe it was the 22nd, is when you saw the Brussels bombings, and just repeating that whole attack and war-type activity. And another thing that I've discussed related to this time frame is swarms of earthquakes. And really, in the first 3 weeks of April, you've seen one of the biggest swarms of major earthquakes in such a narrow window of time that we've seen in decades, maybe in centuries, with really the two most noteworthy being the one in Japan about a week ago, 7.2 I believe it was, and then immediately following the one in Ecuador, also I think it was 7.2. But if you just took the week leading into that, there were 12 earthquakes around the globe, 6.0 or greater. If you take the 3-week period that started off April, we saw 19 major earthquakes, and 8 of them 6.5 or greater, and even 6 of them were 6.9 or greater, which is getting into some very significant earthquakes, spread all the way from Afghanistan to the South Pacific, to the Philippines, to Myanmar, Alaska, and then Japan and Ecuador, and then Guatemala. There was a significant one too. So it's when things really come back to life, and you see it in the markets too. And that's why I was expecting gold and silver to enter the next phase of their advance, leading into and out of the mid-April time frame.
Now, how does that affect the markets?
Well, if you're referring to stock markets, I do think that they could be culminating the rally that they've seen since late January. The markets often move in what's sometimes termed geometric phases or cycles, and that is those time frames that are very related to the divisions of a circle. A year technically is 360 degrees, almost 360 days, a couple more. But seasons are divided up just like a circle that's cut into quarters at 90-degree increments. And you also see time in the markets moving in those type of periods too. And we've just seen a 90-day, 90-degree rally from the late January lows in the stock market. So from a general standpoint, you're coming into a time frame where it would not be surprising to see a top and start to see some movement back down. But there's a lot of other indicators, some overbought indicators, different technical levels that are being reached that corroborate that and start to hint that at least an intermediate top could be in the making. But again, I'm really focused on the gold and silver market and what that means for both the current time frame and looking ahead. And this period leading into April 19th did not disappoint. I'm not sure how many of your readers are aware of it was a lot of speculation leading into it, but the thinking that April 19th would be when China initiated a yuan-based gold fix to begin to compete with London and New York in the pricing of gold. And sure enough, right on April 19th, the Shanghai Gold Exchange did fulfill those expectations. initiated this gold fix, and it has certainly spurred a quick, sharp, additional rally in gold and silver. But I've also explained why I thought that particular fundamental event would be more a culmination of the first big rally in gold and silver, and that a lot of my work shows that gold and silver should be peaking by April 21st or 22nd, and that silver has some key upside targets between 1760 and 1780, with gold still kind of confined by its early March high and looking less likely that it will get above 1280 before another intermediate top takes hold and maybe a 1 to 2 week or 2 to 4 week sell-off. But I'm turning more and more focus to what's going on in gold and silver because I think that's going to impact all of the financial markets in the coming months and years.
Once people really start focusing on gold, stocks, I wonder, is it cause and effect that people go to gold because stocks look like they're a poor bet? Or is it the other way around? Because gold looks so much better, people just forget about stocks.
Yeah, and I think that when you start getting too focused on the chicken or the egg debate, you kind of miss the bigger, broader movement. And I think that both of those activities, the move into gold and the move out of stocks, which really are a kind of a proxy for our entire fiat currency structure, that's, paper assets versus hard assets. The bigger thing is that we are seeing this major shift, and it still is in its early stages, still hasn't really hit the tipping point, but the momentum is building, and this is that whole 40-year cycle discussion that I just keep coming back to. And you looked at the mid-70s, and that was a very watershed series of events where the West was completing its abandonment of gold backing of currency, of any linkage between our currency to hard assets, and that whole period, really from 1971 to 1976, were several major events, starting with the Nixon gold shock in 71, the collapse of Bretton Woods in 73, the linkage of the dollar, the de facto backing of the dollar by oil, ushered in 73 through 75, but then the culmination of that period, the real definitive act, in my opinion, was the 1976 Jamaica Accord, which basically was the entire West putting into writing, officially decreeing that gold now had no remaining link to all the wonderful fiat currencies. And my contention has been that that triggered another 40-year period, a 40-year cycle, which is a cycle of testing, a cycle of transition and preparation, and that come 2016 and beyond, we would start to see a big shift in the opposite direction, but, it appears it's the East that is really pushing this move back towards gold-based, hard asset, true solid-backed currency, and that the West could really be scrambling in the coming years if that movement takes hold and gains momentum. And so you kind of see both. You see the move into gold and silver and hard assets, and you see the move out of stocks, fiat currencies, probably even out of bonds in the coming years.
You're listening to This Week in Money. I'm Jim Goddard. We're speaking with Eric Hadik, CEO and president of InsideTrack.com. Eric, the Canadian government sold off the last of its gold assets just a few months ago. Was that the right kind of move?
It was, if you're looking at the way markets work, and that you have the uninformed and the majority selling at bottoms and buying at tops. I think that this is also kind of a battle between the West and the East, and the West is going to try and keep gold under control as long as possible, whereas the East, particularly China, the more that they have invested in gold, the more they'd like to see the price of gold float free of dollar manipulation and really benefit them, because they have been putting a lot into gold, and China's now both the biggest producer and biggest consumer and holder of gold. So it certainly is a battle. It's kind of like the 1990s, when every time gold would try and rebound, you'd have central banks of Europe and the West selling gold to keep pressure on the price, and then that whole exercise kind of went on sabbatical during the 2000s, and you saw gold, skyrocket from under $300 an ounce to $1,900 an ounce in about a decade. And then since then, you've seen a few years of some selling. Silver's gotten hit a lot harder than gold. But at the same time, ironically, the same month that gold was peaking in August 2011 was really when different global countries started to repatriate their gold and start to bring it back home, often from London and or New York. It started with Venezuela, then it started to gain a little momentum with some other lesser influential countries, but then that picked up with even Germany and other European countries, several of them having referendums, the Swiss did, on the idea of bringing the gold back home. So you've got a lot of undercurrents going on that I think that the general masses are ignorant of, and it's going to be one of those days when the tipping point is finally reached and you wake up and gold is just taking off and everyone's saying, what happened? I didn't see this coming last week, and yet it's something that has been developing for years.
Do you see a short-term correction in the price of gold and then it starts to take off, say, at the end of the year?
Yes. I've been saying all along that I thought 2016 would be the first significant advance in gold and silver, and that advance would really be the warning sign that the tide has turned and that gold and silver are starting a new bull market, but also that I thought it would be a very volatile year as this battle plays out between the last clinging to paper assets and the initial move into hard assets takes hold. And even within a very short time frame, I've been saying that the month of April would be very volatile, and I thought we'd see swings from when cycles turned positive again, leading into mid-April, but that would probably only trigger a quick 2 to 3 week surge into when intermediate cycles see a peak between April 21st and 25th. So I am still anticipating, and silver is in the midst of one of its biggest 2 to 3 week surges in years, and I think that will culminate here on the 21st or 22nd, and we'll see another correction. And I think that you could actually see a series of those type of quick surges and then corrections, kind of setting a new plateau throughout the year of 2016. I think that the dollar even has one more last gasp rally in it in 2016, which could be what ushers in one of these corrective phases in gold and silver, even though I don't think that they will go back to their lows. They would just kind of mark some time as the dollar tries to give one final rally, and then once the dollar peaks, that would kind of be the lifting of another weight off of gold and silver and allow them to really accelerate their new bull markets.
Of course, we're talking U.S. dollar, right?
Yes, yes.
What about the little old Canadian loonie, which has actually seen quite a big rise over the last few months?
Yeah, that goes along with what you and I have been talking about last year with, and that was more the discussion on oil and petro-related currencies, that all of my multi-year cycles were showing strong downward action from mid-2014 into the end of 2015, and then a very likely bottom in the first quarter of 2016 with the majority of monthly and weekly cycles coming together in January of 2016, and ushering in what I thought would be at least a 3 to 6 month and potentially a multi-year low in the oil markets, in Canadian dollar, in the Russian ruble, those things that are very closely linked with the price of oil.
Eric, how can people find out more about InsideTrack.com?
The best way is to visit our website at InsideTrack.com. That's InsideTrack.com, so it's got the extra I in the middle. And also, it's got another website, 40yearcycle.com, the number 40, and then the words yearcycle.com, where a lot of the corresponding 40-year cycle analysis is published, and just kind of really intensifying the focus on this time frame, particularly 2016, 2017, and just the overwhelming amount of long-term cycles that are showing the potential for a seismic shift in the markets during this time frame.
Eric, thanks a lot for being on This Week in Money.
Thanks for having me back, Jim.
My guest has been Eric Hadik, CEO and president of InsideTrack.com. Coming up, Robert Campbell, next on This Week in Money.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at TalkDigitalNetwork.com.
My guest is Robert Campbell, publisher of RealEstateTiming.com. Welcome to This Week in Money, Robert.
Hi, Jim. How are you?
We're doing great. Vancouver has been making international headlines for the kind of real estate prices we're seeing and sales. Shacks on the west side of Vancouver going for $4 million, sometimes $5 million. They were listed at 1.2. What's happening there, and what are you seeing in San Francisco?
What I'm seeing in San Francisco is that after a 3.5 to 4 year run-up in real estate prices, where housing prices have almost doubled, we're starting to see early signs right now that the bubble, and it is a bubble, is starting to burst, and that prices may come down to reality again, Jim.
What kind of insane prices have you seen there?
Well, the kind of prices, when I talk about San Francisco, I'm talking about the city. I'm not talking about the Bay Area in general. That includes East Bay, and down the peninsula towards San Jose and Santa Clara, in that area. But in the city, housing prices, a little less than 4 years ago, the median priced home was $700,000. Today, it's almost $1.3 million. And that's all in about 3.5 years. And if you were to look at a graph of that, you could just see it has literally, risen at about I would say about a 60-degree angle. And for anybody that's been around any period of time and that's studied market trends, something like that has almost a 100% certainty of resulting in a big fall afterwards, because it's completely unsustainable.
What has driven those high prices?
What has driven them? Two things. The biggest thing has been the boom in the tech market down the peninsula in the Santa Clara market, where, people that work for Google and Facebook are making huge salaries, and they, housing prices down that area, you can have a $1,000 100 square foot fixer upper, 1,000 square foot fixer upper next to the freeway down in San Jose, Santa Clara, and that thing sells for $800,000. So people are moved up to the city because everybody wants to live in the city, and that's what's boosted prices up there. Also, we have an influx of Chinese money coming into the San Francisco market, capital flight, and a lot of that money could be coming out of Europe as well, and also low interest rates, Jim. Low interest rates have just driven housing prices in the city, along with every other place in the United States, much higher than they should be. But the San Francisco market has turned into, it's extremely speculative, and in my mind, it's a bubble and it's going to crash.
Have you seen any cracks in that bubble yet?
Sure. In fact, what we've had, the first crack that we've seen is in the condo market. Condo prices have just been have been as strong as housing prices, and what people have done, because there's a shortage of land, of course, in San Francisco City, is the condominium towers are going up right and left everywhere. And what these things are, they're 1,000 square feet and they're selling for $1.1 million, that kind of thing. And so what that has done, all of a sudden we have a supply of condominiums that has hit the market, and it has increased inventory by 40%. 40%. So there's this glut of condominiums, high-priced condominiums hitting the market, and it's just pure supply and demand. The demand isn't there. So, and what people are doing now, not only are people, resisting paying these high prices, a lot of people are crossing the Bay Bridge, going east over toward the Oakland side, the Danville side, and they're buying property over there as opposed to in the city, because they only have to pay, approximately 60% of what you have to pay for it in the city. So there comes a point when prices do get so high that there's a lot of resistance to paying those prices, and that's what we're seeing right now.
Of course, most real estate markets are driven by first-time buyers. Have first-time buyers in San Francisco been frozen out?
No, they're totally frozen out, Jim. Totally frozen out of the market. I know there's a lot of young kids working for Google and Facebook and all those high-tech companies down in the Santa Clara, Silicon Valley area. However, those guys maybe are making, $100, $150, maybe sometimes if they're really good, $200,000 a year. That doesn't cut it if a home costs $1 million. I'm sorry, it just doesn't make it. I don't care what even though interest rates are 3.5%, you still can't cut it. So most of these guys that are paying the money for these homes are people that already have owned homes in the Bay Area for a while. They've got huge equities built in their homes, and they're trading up, or it's new money coming in from countries like from Europe and China and Russia.
Russia even. Even down where I live in San Diego. I live in a fairly affluent area, about 4 miles from the beach. There are a lot of Russians. I don't know what the situation is, how they get this kind of money,
but there's a lot of Russians in our area, and Chinese, of course. I'd say the area I live in right now, I would say 20 years ago, it was probably, let's say, 5 to 10% Asian. Today, it's probably 35% Asian, Jim. A lot of Asian money coming into the Southern California coastal markets.
Do you have any theories about why so much Chinese money is hitting the West Coast?
My first idea is capital flight. But the other thing I can see is that, the schools tend to be real good next to the coast because they're, wealthy people tend to have good high schools and good grade schools, which is the case, and Asian people are very, very, very disciplined people, education-oriented, and they want their kids in the best schools, and they'll pay the price. So they come to San Diego or Los Angeles, and they buy something expensive in the coast to get their kids in the best schools so they can get to the best colleges. UCLA, where I graduated from, Jim, when I graduated back when the pterodactyls were still roaming the earth in the 1960s, that I would say the school was probably 5 to 10% Asian. I bet you today it's probably 40 to 50% Asian. There are smart people, these Asians. I go to the public library here in where I live after school. 90% of the kids in there are Asian. These parents want their kids to study hard, be smart, get good jobs, and they just dominate, the college enrollment. They apply themselves more, and they're smart people, and they're just flooding into the more expensive coastal areas in California.
We're speaking with Robert Campbell, publisher of the realestatetiming.com newsletter. Robert, taking a look at the experience in San Francisco, how does that translate to the Canadian real estate market, where Toronto and Vancouver prices for both homes and condos have skyrocketed over the last 2 years?
You guys in Canada have had it so good for so long, just knowing the nature of markets. In my mind, I've never told people to sell in the Canadian area. I just keep telling them to watch key indicators as they climb and climb and climb. The Bay Area has been the Bay Area in California, San Francisco area has probably been the best place to invest in real estate in the past 30 years in the United States. And I bet you Vancouver would qualify as probably the best place to invest in Canada. Both of those places then, they are not immune to falls. They are not. That's just the nature of markets. They will reach a point and something will trigger a decline and they'll go into a big fall. And people that are, unlucky enough to buy at or near the peak are going to get killed in both cities.
Is it more important to look at a home as a place to live or as an investment?
I think a home is a place to live. The home, if you're an owner-occupant, I look at it as a place to live. However, you better be able to handle that mortgage come hell or high water. Then it's a place to live. Either you're going to rent or you're going to buy and live in it. So, most people would rather be owners than renters. And if the market value of their home falls 10%, 20%, even 40%, as long as they enjoy their home and they've got a good job and they can afford the mortgage, I think they're relatively okay. Investors, however, that's a completely different situation. Now, as far as timing the markets, buying at or near a top. However, from an ownership standpoint, to step into a bubble market, such as Vancouver or San Francisco, that's a whole different thing, Jim. Even if you're going to live in the thing, unless you're just a very, very wealthy individual and you buy a home for $2 million and you don't care if it goes down to $1 million, sure, go ahead and buy into the thing. That's fine. But most people, don't have that luxury to do that. So, buying at or near a top does have its risks, even if you're living in the thing.
Vancouver now is almost being looked at as a resort community where only the rich can afford to live there or at least own real estate, but the people who work there can't afford to live there. Kind of like a Monaco.
Right. tell me about rents in Vancouver. What is a one-bedroom apartment rent for in Vancouver?
You're probably looking at $1,200.
You know what a one-bedroom apartment rents for in San Francisco City?
No.
$4,000.
Wow.
How the hell can a place only rent for $1,200 with those kind of prices?
Yeah,
a two-bedroom. Okay, let's say you go. You know, it always helps doubling up. You know, it helps share the expenses. Two bedrooms go for $5,000. I mean, and that's not. I'm not exaggerating, Jim. So what people are doing and because I have a lot of my timing letter subscribers live in the Bay Area. What those renters are doing, they're going east not only to buy less expensive homes, even if they work in the city, but also to rent places. Oh, it's amazing. I've heard stories that, you know, that the rent is so high, people are, you know, they're stacking people in these places. I don't know who can afford the rent. You know, you have to, at $5,000 a month for a two-bedroom, you have to be making $60,000 a year, and that's in after-tax dollars just to pay the rent, and that doesn't even include utilities. So, and interestingly, so obviously with these high rents, there's a lot of new rental apartments hitting the market in the Bay Area. And here's another crack I'd like to share with you. The new developers up there that are marketing their apartments, they're offering concessions now for the first time in a lot of years, Jim. You know, like 2 months free rent with a year lease or something like that. So that market's going to get glutted too. I mean, you know, if it's all predicated on getting $4,000 a month for a one bedroom and $5,000 for a two, I guarantee you that is not sustainable. People that buy those apartment units at that price are going to get hurt real badly.
Is that going to be a warning for everybody else that the real estate rise in prices, of course, at 25%, totally unsustainable?
I don't think so. Not yet. That market is by far the most overheated in the United States. Other markets are not even close to that, Jim. But it's interesting. You just never know. You never know what the trigger is going to be. You know, we could have another, you know, tech bust. And how would that affect the U.S. economy? You know, just like it did back in the year 2000. So you don't know how it's going to affect. That's why all you can do is just keep your eyes glued, you know, closely to relevant data that's highly correlated with price movements in the market. And if you're trying to sell at or near peak values for whatever reason, watch the data to get out. But San Francisco is the market I'm watching most carefully right now because that will probably be the first major U.S. housing market to take a downturn.
Well, I have heard they've probably overbuilt the condo market in Toronto, so they might be echoing the same thing as San Francisco's seeing.
See, and what's amazing is this, that, you know, my background is I come from a building background. I'm a son of a home builder. To build out these high-rise towers, condo towers, or apartment towers in San Francisco, do you know what the lead time is to get permits and get those things built, Jim? It's got to be anywhere in the 5 to 7 year range, right?
Yes.
Can market conditions change dramatically during that period of time?
Absolutely.
And so you're just hanging out there to dry, my friend. I come from that background. I know. I have a good friend I work out with. He built homes. He was a pretty big home builder here in San Diego for about 20 years. He built 100, 200, 250 homes a year. So, you know, along that range. And he made a fortune, you know. And finally he sold out, took all his money and just invests right in coastal property, lives very comfortably. And I asked him once, because he knows I'm from that background, I said, George, what do you think? Do you think 1 in 5 home builders, only 1 in 5 home builders, developers avoids going bankrupt? And he goes, that's too high, Bob. So it's a very risky business, Jim. And, you know, some of these guys that are building these towers, this is all spec money. This is all bank money. And if you study the history, you know, of the past with these high-flying markets, and all of a sudden you get these big buildings sold, get these big buildings built, and there's nobody there to buy them, it's a complete bust.
Robert, how can people find out more about the Real Estate Timing newsletter?
You can go to realestatetiming.com. realestatetiming.com, just like it sounds. There's no dots or dashes, and you can purchase my book, Timing the Real Estate Market, that shows you how to track markets with a 85 to 90 degree accuracy. You'll know what the peaks are. Anybody and people in Vancouver or Toronto, they could use this stuff too. And you can also subscribe to my timing letter, where I track 19 major cities in the United States as far as when to buy and when to sell.
Thanks a lot for chatting with us.
Thank you, Jim.
My guest has been Robert Campbell, publisher of the realestatetiming.com newsletter. That wraps up our show for this week. Thanks to our guests, Ross Clark, Eric Hadik, and Robert Campbell. And thank you for listening. Comments or questions for the show can be emailed to info@howstreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of How Street Media Incorporated.